On this podcast with us today is Evan Holladay. Evan, welcome to the podcast.
Thanks for having me, Dan.
Evan, I want you to get us started first before we dive into this property that we're going to be discussing called Brook Point. It's 192 unit new construction property. So before we dive into the details and specifics of that property, give us a little bit about you and your background.
Sure. So in my background, I really got started in real estate in college. It just, I was down the path of pre-med and realized very quickly that I like to help people, but I don't like science and math. So it wasn't going to work out very well. So there was a new mixed use student housing development going on at University of Louisville where I went to school. And I was like, man, I got to get involved in that. I got to learn how he's doing that. Whoever's doing that, I got to pick his brain. I got to get in there. And so I found out who the owner was and really just like called until he would give me a chance. And he's like, all right, well, if you can get, I think he said like 50 people to the groundbreaking, then we'll talk. So I ended up getting a few hundred people to the groundbreaking. I got a few buddies of mine to pass out flyers. We got a bunch of people to the groundbreaking. And at the end of the day, I was the first one he hired on for the project. And I really got to learn all about like the ins and outs of new construction. I got signed on when they were still putting the framing up. So I got to see the whole construction. I got to see the lease up of the commercial tenants. It was all ground level retail, and there's a bank, there's a store, restaurants. I got to coordinate with them, and then I also got to coordinate the whole lease up of, I think it was 380 units. So all of that combined really just kind of like got me super excited for real estate. I was like, man, I gotta like just dive in deep into this. And from there, I ended up, as part of the university, we started a real estate development company. And it was actually a modular real estate development company where we used the same like rectangular shape of a houseboat, the same layout as a houseboat, and used houseboat manufacturing plants in Kentucky. Kentucky is like a mecca of houseboat manufacturing plants. So we used some of their facilities. They laid off 1,100 skilled workers when the housing market crashed. And we're like, well, how can we put those skilled workers back to work and provide, modular housing that can be affordable and energy efficient and deliver it to market much more quickly than like a stick frame style new construction. So we ran with that and got some backing of some, venture capitalists that were really interested in this. And that's when we knew we were onto something. And so that's when I was looking for partners who had experience, who knew what they were doing, who had capital, things that we're all looking for, especially like newcomers into multifamily. They're looking for, what I was looking for at that time was somebody that knew what they were doing already and could help, kind of guide me and also partner with me in order to get it done. When you're looking at with bank loans and equity investors and things, they're not going to sign off on you unless you have some partner or some kind of experience. So that's what we were looking for. And that's when I partnered with LDG and now work with LDG Development. And so we do multifamily new construction, mainly workforce affordable housing development, where we use tax credits, affordable housing tax credits to actually finance part of the equity for the development. So I've been with LDG for 5 years now, and my team has done over 1,000 units over the last 5 years and just a little over 175 million in new construction. So it's been a blast so far, and it's been kind of a whirlwind of just, learning as you go and, just trying to ask as many questions as you can along the way and being persistent and consistent. So it's kind of a little bit of my backstory.
So before we dive into Brook Point, I want to ask you a couple of questions about tax credits for these types of new constructions and, the 1,000 units that you've built and stuff like that. One of the biggest, I would say, considerations for new construction is the lack of cash flow as you're building these on. So how do they compensate for that?
So we are actually a interesting model where we're vertically integrated. So we are technically the GC as well. So we have the general contractor's profit coming in during construction. So that helps as far as cash flow for us as the developer. But yeah, I mean, that is something to consider as far as cash flow. You're literally, it's an 18-month construction cycle, and we'll start leasing up units in month 11 or 12, and then we'll start first units will be occupied in probably the 13th month. So you have basically a year of just no cash flow from the property as far as the rental side, but we're still getting that general contractor profit. But at the end of the day, you're looking at it as, new construction is typically a longer term play where you're saying, okay, well, it's going to take us a while to cash flow, but once we do cash flow, we have a barrier to entry where we are the newest product. We typically try to put ourselves in opportunities where, it's hard for others to replicate what we do. And so that way it gives us a barrier to entry. And it's also, unfortunately, the way it is with tax credits, it is very hard to get tax credit developments done. So that is also another barrier to entry that we have with new construction, is that once we get it completed, we're the newest, nicest, most high quality, affordable housing typically in the whole market. And that gives us the opportunity to be able to charge the highest possible rents under, the tax credit guidelines, which we can't charge too much, but it just gives us a nice barrier to entry once it does start cash flowing.
Now, because of those tax credits, where do those tax credits usually come into play? Is it usually just tax credits to, subsidize the people renting the space, or is it actually subsidizing a portion of the construction?
Right. So none of the residents are actually subsidized. They're all, they all have jobs. They all have to meet a minimum income requirement, because we don't want to let in residents that are not making enough money to afford the rent, and the rents aren't subsidized. So we have to look out for our own interests of the property and make sure these people are making. It's typically depends on the city. It's based on the average median income of the city, but we're looking at basically 30,000 to about 60,000 for, depending on the family size, is what people need to be making. So the tax credits are actually helping subsidize or helping pay for the construction. So we get tax credits from the federal government, comes down to the state agency, the state housing agency. And then the state housing agency looks for and awards projects that they think are, deem merit to actually build affordable housing. So we get this award of tax credits, and then we go out to the marketplace and go out and sell these tax credits to banks who need the tax credits, who are required to buy these tax credits by the federal government. So the banks are actually buying the credits and giving us cash in the form of equity. So it's almost cheapens our cost of equity for the development. And that way, it basically, if you look at a capital stack for one of these deals, it's typically you have a loan for about 50 to 55% and tax credit equity in the form of the tax credits in 30 to 40%. And then the last gap is either filled by the developer, city or the county or the state that put in funding as well.
So when you're talking about these types of new developments, it's not usually working with outside investors or anything like that. It's usually just you either working with the city, the county, the state, or even just the developer putting up some skin.
So yeah, in essence, we're not, it's not like your standard syndicated deal. Yeah. It's not like you're going out and talking to doctors or lawyers or high net worth individuals. It is more direct to market or direct to banks. But we use syndication shops where they actually aggregate a bunch of different banks and pull their money, and they'll have, depending on the year, they'll have a few $100 million fund, and then they'll go out and place a multi-investor fund. They'll go out and place that in a bunch of deals and then sell that fund to a bunch of different banks. But it's typically banks. Sometimes there's insurance companies, and then sometimes there are just, economic investors. We've had Google invest on a deal. We've had Sherwin-Williams invest on a deal. It just kind of depends.
So with these tax credits, what stipulations do they put in place? Because obviously when they're giving you money to be able to build something like this, there's going to be certain, like probably some caps on the rents and stuff like that they might put in place, right?
Right. So that's what, we get this equity, but there is something that we have to commit to doing in order to get the equity. And that is, like you said, we have to cap the rents. So the rents are capped at 60% of area median income.
Wow.
And so that's the most you can charge. So, I mean, it depends on the city, but it'll range from anywhere from $700-800 for a 1 bedroom up to 1,000 to 1,200 for a 3 bedroom. So it's really inexpensive for a brand new construction unit, but it gives the opportunity for these families who wouldn't otherwise be able to ever afford a brand new place to be able to live in an affordable community. But the other, what was that?
No, I was just going to say, how long are those stipulations in play?
Right. So the stipulations are typically in play for 15 years. That's the tax credit compliance period. And then states can elect to add on to that tax credit compliance period on top of the federal requirement up to 30 or 40 years.
Does that make it harder to sell it?
Yeah, it does. But we've kind of adopted the model of not selling any property, and just once it gets out of that 15-year cycle, either buying out our equity partner and holding on to the deal long term, or actually re-syndicating the deal with new tax credits and just prolonging the affordability cycle, and almost like, adding value to the property or rehabbing the property and then just restarting the affordability period.
Okay, so it's more just getting it leased up as much as you can, and then just holding on to it for a long-term play. And then would the play be that once these tax credits expire to then sell it, or would it be just to continue to hold it?
It depends on the deal, but typically we've just kept it as affordable throughout, and then depending on the deal again, but depending on if we want to prolong it or if there's a opportunity for more tax credits, then we'll definitely pursue that. But yeah, it's typically been maintain affordability.
Well, that's interesting because I've never heard of how those tax credits work. But just kind of recapping there, the federal government gives it to the state, and the state allocates it and awards it, and then you as the developer would go and actually sell them to banks, and banks would buy them and give you the cash in return.
Correct.
And they would also get the equity in the deal too for buying those tax credits.
Yep.
Yeah.
It's a good summary. Not bad, Dan.
That's
You're
interesting.
basically
That's
affordable
interesting. I've never
development.
heard of it that way, but it makes sense. I mean, I've heard of like other tax credits. Like I know in Georgia right now, they're doing really big on the, which is why you're seeing a lot more of the Hollywood style, people going into Georgia's because they have
Right.
movie tax credits, and people are buying and
Right.
selling those things left and right like that.
Yeah, and Georgia actually has their own state housing tax credit.
Hmm.
So the federal government has their own credit, and then some states have their own credit on top of that to further incentivize affordable housing development.
Mm-hmm. So is the biggest play for it's LDG development? The biggest play for them is really to do these affordable housing complexes, but be the GC, and that's where they're making most of their profit, or a lot of their profit is in that development side and the build side of it too, right?
So there's also the whole in affordable housing they allow developer fee. So that's another incentive for developers to do affordable housing, because there is that rent restriction. They have to incentivize developers to pursue affordable over, say, a comparable market rate property. So they allow, depending on the state, anywhere from 12 to 15% of the total project can be developer fee. And so you can take that, depending on how well sourced your deal is, you can take that between construction. It's typically taken through stabilization and out of cash flow. But that's another source of income for the deal.
So even after the project has been built, whatever the cash flow is off of that property, they can still take that fee.
Correct.
That's interesting. So then I think another misconception that I've had on this too is that affordable housing, they're getting Section 8 and all that kind of all the different vouchers and stuff like that into these properties. But what you're saying is it's really not, because it's actually built into the build of the property that locks in the lower rate instead of having to have these different voucher programs.
Correct. So there's different types of affordable housing, but the type that we do, I mean, there are developments that are purely Section 8 or purely project-based voucher developments, but that's not what we do at our properties.
Do you guys accept those vouchers at all?
We do, but they also have to meet our rental guidelines, and we have pretty stringent rental guidelines just because we want to keep a high quality at our properties.
Yeah. So when you're talking about these new builds and you're putting them together, are you putting in Class A type luxury amenities, or is it going to be kind of still like a basic development?
I would say the amenities package and the size of the units are comparable with a market rate style community. It's the finishes that aren't nearly a Class A, but they're, just one step below. You're still going to get your GE appliances. They're just not going to be the stainless steel. They're going to be the black finish. So it's
Yeah.
just things like that where you get the same, really, I mean, the units are huge, and that's
But
one.
you're not putting like crown molding on and 6 or 8 inch
Correct.
bases or anything like that. You're probably doing your standard 3.5 bases and, no
Correct.
crown molding, just straight, laminate countertops, that kind of stuff too.
Correct. So it is more of a basic finish, but as far as the unit size goes, it's right on there with market rate style.
What about other amenities like pools and fitness centers and stuff like that?
Yeah, so we have pools, we have fitness centers, we have a community clubhouse area where they can gather, do events and whatnot. We do playgrounds because we do have more families at our properties, and we try to do like a walking path and a dog park. So there are quite a few amenities that we include in our properties. But yeah, it's comparable on the amenity side to a market rate development.
Mm-hmm. Okay. Interesting. All right, let's dive into Brook Point. I know it kind of took about 20 minutes to go into all that, but it's definitely something that I think a lot of people in this multifamily space are not aware of how that affordable housing, new development, new construction works. And so wanted to be able to dive into that a little bit. So some of these questions I'm going to ask you are not going to be applicable, but we're going to go through them and kind of, get the details on Brook Point, which is a 192 unit new construction build. And where is this one located?
It's in Lafayette, Louisiana.
Lafayette, Louisiana. And how did you guys come across this particular project?
So actually, it started out right about when I started at LDG. We were looking for new developments in Louisiana. We knew they had funding available, and kind of a roundabout way. Long story short, we got NIMBY'd, which is not in my backyard. It's kind of a development term where the neighborhoods will not support you. So we got NIMBY'd at 3 different sites. So this was actually our 4th site in Lafayette. We already had funding on the first one. Then we had to ask the agency and the city to move the funding, which everybody was on board with, just because they have a huge need for affordable housing there. But this site in particular, we ended up with probably the best site out of all of them. It's right behind a Walmart. It's right off the highway. And we're actually getting quite a bit of, I think it's in total, it's 13.1 acres that we bought. And so what we do is when we're going through development, we have to line up all the pieces of the puzzle all at once and close all at once. So I think it was about 2 weeks ago, we closed on the land and we closed on the construction financing, which simultaneously closes on the perm financing because it's the same lender. So we moved on that, and then we're actually going to start in construction in next Monday. So we'll be in construction probably by the time this thing airs.
So how long ago did you guys first start working on this particular piece of land, this 13.1 acres? Was this, a couple of years in the working?
Yeah. So we've been at this for about 3 years. And I think at this site specifically, and then in total in Lafayette, I've been working there about 4.5 years.
Wow.
Yeah. It's a grind.
What's the biggest and the longest piece on trying to find and kind of get these deals, through the finish line?
It depends. It really depends, but typically entitlements. It's typically like in Nashville, we have a problem where there's no more zoned land left. So every project we've had to do since then in Nashville has had to be rezoned, and then we have to go through and get our permits as well. So rezoning takes about a year, and permits take about a year in Nashville. But that all depends on the metro or the metro government. But yeah, I would say entitlements are typically your longest due diligence item. And with our investors, we can't close without entitlements in place. So they won't close on the financing until they know we can start moving dirt tomorrow.
Yeah.
So that's typically our longest lead time item. Sometimes you'll have, different state agency or if you're using HUD financing, like a HUD 221D4 loan, that's very time consuming and very, that will make you want to pull your hair out, but sometimes it can be worth it. But yeah, there's a lot of different things, but I'd say overarching probably entitlements.
And what is the what have you ever had it happen where the land that's being sold, somebody else comes along and buys it from underneath you because it took too long?
We always put very lengthy contracts on our land, which ties up the land, so we have the right to purchase it, and they can't go out and sell it to somebody else. We have had times where, sellers have said, hey, enough's enough. And we understand where they're coming from. It's just sometimes, like these entitlements or the state agency things are outside of our control. And, the project just keeps getting delayed and delayed. And so there's been times where we've had to purchase the land before we're actually ready to close. So we'll get a land loan and purchase that, but we don't prefer to do that, just having that risk out there on the land without any entitlements or ability to develop the land.
Yeah, and is this raw land, or is it cleared, or is it already staged, or how does it usually look?
It depends, but it's typically just raw land. It's just like a field, or if we're doing an infill, like I've had one where it was just like, it used to be an RV sales lot. It's just stuff like that. It depends on the development. It depends on the area. The one we just closed on Brook Point, that actually used to be a pecan orchard. And that whole area actually used to be a huge pecan orchard, and they've since abandoned it, and basically over the last 50 years have sold off pieces. And this was like the last remaining piece in the whole neighborhood.
And so how long is it going to take you to build those 192 units?
18 months.
18 months. Wow. That's pretty quick.
Yeah.
So you'll basically have the first units available around that 11 or 12 month mark and start having to move in on that 13-month mark. And How many different buildings is this going to be?
This will be 8 buildings, 24 units each, split between 2 and 3 bedrooms. It'll be a gated community, clubhouse, pool. We'll have garages, playground, walking path, big pond. So it'll be a nice new development. But yeah, we typically stage the development so that we can start delivering units as soon as possible. So we'll get that first building in probably month 12.
So going back to, this thought just hit me about the affordable housing side of this. And are you required to make sure that their income is not higher than a certain amount?
Yeah, so that's the affordability requirement, the 60% of area median income. We have to make sure that their income doesn't go above, depending on their household size.
Yeah.
It can be up to 30,000 for a family of 1 and up to 60,000 for, I think, a family of 4.
So if they make more than 60,000, they could not rent from you.
Correct.
Okay. I was thinking it was the other way around, that they had to make at least 30 to 60 in order to move in.
So that's like the ceiling, but then there is like a floor. And it's honestly kind of a thin band of people that we actually hit, because they have to be making enough to pay rent right here, but then they can't be making too much to go above the affordability.
Mm-hmm.
So there's different types of housing that hit down here, and there's a little bit of options that hit up here, but there's really not much. But we hit like that kind of middle income band.
Mm-hmm. Wow. And obviously when you're marketing this particular property or whatever, you're putting that in the marketing so that people know that it's affordable housing, and we have certain income requirements and various things like that too, right?
Correct. Yeah. We honestly have to turn down a lot of people because we build, we pride ourselves on our building quality, and we build to hold it. So we build quality long-term properties. And that's why, a lot of people that are over income come knocking on our doors, and we have to unfortunately turn them away.
Yeah. So how do you structure these deals with investors?
So it's interesting structure on affordable. It's probably not like anything market rate or anything you'll ever see on the market rate side. They get the tax credits, and then they give us an infusion of cash based on some percentage of the tax credits. So then you negotiate that percentage. So typically the way they do it is the investors, the syndicators, usually, sometimes you'll go directly to banks. but the syndicators will tell you, hey, for every $1 of tax credits, we will give you 92 cents or 90 cents on the dollar in cash. So it's their way of making sure they get a little bit of yield. And then we, as the developer and part of the ownership group, we will sign a document agreeing to deliver those tax credits, pass those on to the investors. And so we actually get tax credits. Kind of interesting. We get them in 1/10 of the total amount over 10 years. So the tax credits actually come in over 10 years for an affordability period of 15 years. And then, so we're in partnership with this equity investor for 15 years. But the way it's structured is these investors are actually more interested in the one, tax credits, and two, the losses and any depreciation of the property. They look at this as, you look at these ginormous banks, these multi-billion-dollar banks, and they see this as a return by lowering their taxes. Basically, that's what they're looking for, is a way to lower their taxes by the tax credits, the depreciation, the interest that they're paying. They can write all of that off. So they're
still get income off the property, but that's not really what they're doing it for.
Yeah, and it's minimal income because the developer fee usually takes up 100% of the cash flow. Okay. And then after the developer fee is paid off, then it's split 90-10 with developer taking 90%, equity taking 10%. So they're
that's huge. Yeah,
they're less interested in the cash flow than they are in the tax write-offs.
Wow, man. That's interesting.
Yeah, it's unlike any market rate structure, but again, you're looking at less cash flow. You're looking at less upside because you can't control the rents. The area median income controls your rents. Mm-hmm. So there is less upside, and that's why they try to incentivize you by, giving you the developer fee and, letting you take more of the cash flow.
Now, are there groups that are out there that come along and want to buy the property after the developer has been done, to just buy the property and then just kind of take it on for the next 15 years? Or is it basically one of those things where you just really can't sell it for the next 15 years?
Yeah, no, there's definitely groups. I mean, affordable housing is kind of a niche within real estate, and there's so many groups just within affordable housing that specialize in all different types of affordable housing. So we do new construction, and we do build and hold, and we hold our developments. But there are groups out there that they'll build it, develop it, lease it up, and then you can even sell it after, year 1 or 2. You just have to get the approval of your investors and the state agency. But a lot of times it's easier to sell after year 15, after that original affordability requirement rolls off. Even if there is a state requirement, it's usually much easier to manage a state requirement than it is a federal requirement. So at that point, typically groups will sell it off. And then there are like a whole nother group of investors that specialize in buying existing affordable and continuing affordability.
So is there anybody in there that buys these properties and then basically tries to turn them into more luxury type properties instead of keeping them as just affordable housing?
Yeah. There's quite a few groups that do that as well.
Okay, so it's kind of a whole mix and match of different types of pieces inside of this thing.
Exactly.
Yeah. So as far as raising capital for this deal, did you have to raise any capital for this deal outside of, going to the banks and, getting the tax credits exchanged and stuff like that?
So we actually worked with a proprietary investor, a local investor, Iberia Bank, and they funded all the tax credits. So they were our sole investor. Okay. They basically, so each bank is required to invest in these tax credits, and they have a Community Reinvestment Act that basically makes this requirement true for any banks. If they want to expand or they want to buy other banks, they have to have a good CRA score. In order to get a good CRA score, you have to invest in tax credits in your banking footprint. Mm-hmm. So this is right in their backyard. It's in their headquarters are based in Lafayette. They're the biggest bank in Louisiana. They're all the way to Florida, Texas, and Tennessee now, but they're based in Lafayette, and there hasn't been any new affordable developments recently. So they were chomping at the bit to do an affordable housing development right there. So they were our sole investor.
Okay. And so outside of them, did you have to bring any, did LDG have to bring any of their own capital to the table?
We did in the form of, we had certain fees that we actually had to roll into the deal. So
Mm-hmm.
that was just something that we don't like to do that, but sometimes it happens on a deal when it's tight on cash and we have to roll in our fees. So
Mm-hmm. So what's the total amount that's going to cost to actually build 192 units?
it's just over $34 million.
34. So let's just do some simple math here. Take this 34 million, and we're going to divide it by that 192, right at about 177,000 a door. Is that about right?
Yep.
And is that typical for most markets, or does it kind of fluctuate, depending on the market?
Yeah, I would say it depends on how much you're paying for land. And I mean, our type of construction, we do garden style, 3-story walk up. We've got it down to a system now where we can kind of see, within a few $1,000s based on the market, from Texas, Louisiana, Georgia, over to Tennessee and Kentucky. We're all, within a few $1,000s, but yeah, it depends on the market, but that's pretty standard for what we've seen is somewhere around 175 to 177 per door.
Okay. And then for these particular units that you have, what's the unit mix on it?
It's split between 2 and 3 bedrooms.
And so how many 2 bedrooms?
I think that's 96.
Okay. And then the 3 bedrooms?
96.
90. Okay, so it's 96, 96.
Right.
So just split 50-50 as far as the 2s and the 3s.
Yep.
And do you guys have projections on what you're going to be getting for the rents on the 2s?
So we have $730 for the 2 bedroom and $885 for the 3 bedrooms.
Okay. And so what's that going to be projected for an NOI over a year? Not NOI, but income. Not the net operating income, just the straight up income. 730 times 96.
Let's see. The revenue would be 1.8 million in total with other income, and then the NOI would be 950,000.
Okay, 950,000 is the NOI. So we're looking at a 2.8 cap. Is that about right?
So we actually, within our developments, we actually don't consider and that's why affordable housing is a little unique because we don't look as much at a cap rate. We don't look as much
because it's more tax credits that you're looking at. Exactly,
because it's just a totally different underwriting model because we're looking at the tax credits. We also have the developer fee, and it's a different way of underwriting and seeing a return on a deal. And unless we're on a normal deal, Brook Point is a little unique because we did roll in some of our own fees. But on a normal deal, we are really, at the end of the day, once we close and get all of our reimbursables back at closing, then we're into the deal at $0. And so it's, from there, we're just anything above and beyond that is just cash flow directly to us.
So as far as the developer fee that we talked about earlier on this, they would basically take 12 to 15%, depending on what the fee is, on the 950,000 after the debt service. Well, is it based on the overall income?
So no, the 15,000 is based on the total development cost minus certain fees like the GC profit and the developer fee. You have to take those out of the calculation, but it's based on the total development cost. So the developer fee for this would be 3.6 million.
Okay. And that's basically the developer fee plus the GC fees. Yep. Now, once they actually have the property, though, let's say we're at year 2, the property's already built, it's fully leased up, you got your NOI or your income coming in, and you have the NOI at 950. You have. I'm just looking at this, doing a little math here. So you have what basically 1.86 million coming in and income. That's basically projected like full 100% occupied rental income coming in.
Right.
And you're in year 2, development's already done. They're still getting 12 to 15% of the income as a developer fee.
No, so the developer fee is a percentage of the total development cost, and that's
Okay.
paid out of cash flow, which will actually they prefer the developer fee paid off because you have to have that paid off by year 15. So that actually gets paid out of cash flow. That 3.6 million gets paid kind of in a first lien position after the mortgage, to be paid out of cash flow. So for example, like the first year, we're showing 116,000 of cash flow after expenses and debt service. So that 116,000 will go toward paying off that 3.6 million.
Okay, I gotcha. Okay, that makes more sense, and that might take 15 years to do, but they get paid that after the debt's been after. So you have this NOI, you pay the debt service, whatever is left, that would be split 90-10, 10 with investors, 90 with the pay for paying off the actual fee, the developer fee, or would it be pay the developer fee first, and if there's anything left, then you do
Yep.
90-10.
Yep.
Okay, that makes sense.
Yeah. Developer fee is first because everybody wants to get that paid off because the IRS said if you don't pay it off by year 15, then you have to pay taxes. You have to pay whatever's left out of pocket to yourself, and then you have to pay taxes on it. So it's kind of a double whammy if you don't pay it off by year 15. So everybody's goal is to get it paid off by year 15, which is why it's typically in a first lien position right after the mortgage.
Okay. And then when you sell this property at let's just say year 15, in the year 15 or 16, if you will,
Right.
how is the equity or upon sale split? Is it just 90-10? 90 is going to go to the developer and then 10 is going to go to the investors?
Correct.
Okay.
But it is at a discounted rate because you have the affordability restrictions. So that's the interesting thing about affordable is, we're building, it's going to cost 34 million to develop it, but based on, the cash flow and based on cap rates, we're probably looking at like a $20 million valuation or even
Yeah.
like an $18 million valuation. So that's where the tax credits and any additional funds from the city or the state help cover that gap of valuation.
I got you. Because what's the cap rate right now and for a typical BC class multifamily in Lafayette?
Probably 6.5%.
So at this particular NOI of 950, we're going to be at 6.5, we're going to be at 14.6 million valuation. So
Yeah,
yeah, that's a
exactly.
big gap to fill. So even let's just say we're 15 years down the road and the cap rate's maybe at 6. It's still not going to be that much of a difference because even at that, you're going to do 950, and it's going to be 15.8 million. So yeah, I see what you're saying there because those tax credits really fill that gap. That's like a double in valuation, or even more than double in valuation for the cost to build that for capping the rents at where they are. So
Right.
so how does the financing work on that? So if it's going to cost 34 million, are they giving interest only for 15 years, or like how is that actually working? Or is it because they're doing only 50 to 55% leverage, so the debt service is a lot lower than you would if you were going to get a loan on 34 million?
So yeah, so they do 90%, they do up to 90% of the valuation for the loan sizing, but the valuation is based on, I think we had a 5 or 5.5% cap rate on the valuation. So we're getting our loan is 14.3 million. So for them, they look at it and say, okay, well, really in the total development cost, we're actually only doing, what is that? It's less than 50%.
Mm-hmm.
It's 41% of the deal that they're covering. So like you said, we have lower debt service coverage. And then they also are secured because if for whatever reason we default, which is very unlikely with all the partners involved and all the people looking into the deal. But if they're, for whatever reason we default, then they are allowed to take off the affordability requirements. So then they have a $34 million property with 14 million in debt on it.
Yeah. Because then they could just, like you said, if they had a default, they could just take the money. They could just raise the rents and increase the NOI and,
Exactly.
sell it for the 34 million. Wow. Okay.
But the equity investor could step in before that. So the equity investor, because they're getting the tax credits, are very incentivized to make sure the development moves forward and is successful, because if it's not, then they don't get the tax credits.
Mm-hmm.
So there's a lot of partners involved that all are, highly invested to make sure this is a success.
Mm-hmm. It's interesting. So the gap of that, because like you said, that leverage would be less than 50%. So the people who are bringing in the rest of the 50%, like the banks get the tax credits, they're still only getting 10% of the equity, right?
Right.
Yeah, and the developer's getting the other 90%.
Yeah. Yeah, and that's the loan is a 40-year 40-year perm, and then that's they basically put a balloon on it on year 16, so we refinance after the 15-year affordability period.
Do they do any interest only?
Yeah, they do interest only for just under 3 years, and that
Gives you
allows
time
us
to lease it up.
Exactly.
Okay. Do they delay the payment period while you're developing it?
So we actually set aside interest payments on the front end. Okay. So that's already taken care of all the way through almost 3 years. And then at that point, we'll stabilize, and then we'll size the perm loan based on the stabilized NOI and expenses. And then that will start the full payments on the debt service.
Okay. Wow, this has been very interesting. Trying to think of anything else going through this. Was there anybody else that was looking at this land to do something similar or to buy it for any other type of purpose?
There was a few nonprofits that were looking to build. There was one that was looking to build a new headquarters, one that was looking to build a new facility. Mm-hmm. But no, we were the main pursuers of the land.
Mm-hmm. Okay, so you guys break ground on this next week?
Yep.
Next week. So this would be the second full week in January that we're going to be. You'll be how many very first groundbreaking ceremony? How many are you going to have at this groundbreaking ceremony?
So we haven't sent out invites yet, but we're probably going to do it in March, and I'd expect a decent crowd. We're the councilman and the mayor, who have both helped us get this project done, are really excited for it. So I know they're definitely going to be there, and we're probably going to have quite a few more people. So I couldn't put a number on it, but probably a decent amount.
Yeah. Do you have to go down to Lafayette a lot during this process, or is it more just kind of phone calls and stuff like that?
My biggest work is on the pre-end. It's the politics. I've met with the councilman probably 15 times, 20 times. I've been there. Brook Point is a unique deal because it has taken so long. It's taken 4.5 years, and it's died probably 20 deaths and come back to life every time, So I've been there quite a bit, met everybody from the planning to zoning to permits to the mayor to director of economic development, just my job is really to like sell something that doesn't exist yet. So my job is to go in and kind of rile up support and get everybody on board and see the future and see what we can do together to build something for their community. Mm-hmm. Because we always say, this isn't our project, this is their project, because they're going to be the ones that are going to be living with it every day. So we really want them to be fully on board with this. Mm-hmm. So my work is really on the front end. I went down there probably in total like 30 or 40 times over the last 4 years.
Well, I know you're excited to have this thing done or not done, but starting, I guess.
Yeah, no.
It's like a commencement ceremony, right?
Yeah. This is one of those where I'm just like, I just am like kind of in shock that it's finally happening. I'm like, yes, thank you. Finally see some dirt moving.
It must feel really good, because it sounds to me like you started with them 5 years ago. So this must have been one of your first projects that you really started to head up with them, right?
Yeah, it really was. And it was funny because there were two that we got awarded at the same time, this and another project. And the other project's been stabilized for 1.5 years now. And this one's still just broke ground, next week.
Wow. Well, I can't think of any other questions around this topic. You've been very helpful. This is a very eye-opening segment, and I know a lot of people who are interested in this affordable housing space and what you do for new development will be very interested. And I didn't really kind of flow the same flow that I normally do because it's new construction, but I think we got a lot of good information out of here. How can the listeners reach out to you if they have further questions or want to talk to you more about affordable housing or possibly join you as an investor on some of these deals?
Yeah, definitely. So best place to reach me is my website, evanholladay.com. They can also shoot me an email. It's evan@evanholladay.com. We also have the Monumental podcast where Dan was a recent guest. That's a great podcast. So I think those are the best ways to reach out to me.
And make sure you spell your name Holladay so everybody knows. I know for those of you who are watching, it's on the screen, but for those of you who might be driving down the road thinking holiday, like the holiday, like Christmas or New Year's or something like that.
Right.
How do you spell that one?
Yeah, so it's funny because I've told people it's like Holladay. So it's Holladay.
So it's like holiday.
Exactly. You nailed it, Dan.
All right. Awesome. Well, thanks again, Evan. Look forward to continuing to follow you as you move into 2019 and having on a future episode to share some more about your stories.
Yeah, likewise, Dan. Glad to be here.
All right. Thank you so much. I appreciate it.